can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I feel like 100 grand.
You are listening to Inspired Insider with your host, Dr. Jeremy Wise.
Dr. Jeremy Wise here, host of InspiredInsider.com, where I talk with inspirational entrepreneurs, leaders. Today's guest is founder of New Ground Ventures. I'll introduce him in a second, but without knowing, I have featured several of their companies, actually Pipedrive, co-founder, Zach, I don't know if you know this, co-founder Urmas came on. He talked about brain surgery, getting married, and moving to Estonia to the US all in the same year. And at the time, they had 10,000 paying customers when I interviewed them in 2013. Now they have over 100,000 customers. It's amazing. One Hope Wine, which I am one of those customers. One Hope Wine, at the time when I interviewed Jake, the founder, they went from zero to selling over 750,000 bottles a year. One Hope at the time had donated more than $2 million to date, helping provide over 1.1 million meals to people in need and plant 56,000 trees. It's probably a lot more now, so check them out. And before I introduce today's guest, this episode is brought to you by Rise 25. I co-founded with my business partner, John Corcoran, and we help business to business. We help B2B businesses give to and connect to their Dream 100 partnerships and clients, and we help them run their podcast. And for me, Zach, the number one thing in my life is relationships, and I'm always looking at a way to give to my best relationships, and a podcast has allowed me to profile others' thought leadership and bring them on to talk about what they're up to. So if you have questions about podcasting, go to rise25.com. And, a big thank you to Jason Rotman, who referred today's guest, and he helps business owners and families use life insurance to protect and grow assets. The same methods Ultra Rich use. So fun fact is he played football at Princeton, and we sat next to each other in geometry in high school. So Zac Zeitlin is founder of New Ground Ventures, and New Ground is a venture capital investment platform established to fund and support breakthrough companies. And they invest from the early seed stage to businesses with as much as $10 million in sales. And they have a particular focus on food, health and wellness, education, and technology. Some companies I have used or consumed that they've invested in include Kevita, which is a delicious drink, which I think have exited since then, probiotics, kombucha, Copra, which I've tried, delicious coconut water, and other frozen treats, Zevia, all healthy stuff, Zach, because I love what you guys do. And Zevia is, you have to check it out. It's natural, and there's no artificial sweetener in it. And Pipedrive, which I mentioned before. You could check out newground.vc to check out everything they're doing. Prior to starting New Ground Ventures, Zach was a partner at Silver Point Capital and worked as private equity investor at Goldman Sachs. So Zach, thanks for joining me.
Thank you.
So do you remember Pipedrive? How did you first discover Pipedrive?
I do. Actually, one of my business partners and great friends, Sonny Vanderbeck, founder of Satori, co-founder of Satori Capital. At the time, this is before I launched New Ground, we were collaborating on early stage investments. Sonny had just started using Pipedrive. And it's funny, you mentioned, I think, 10,000 customers. I don't remember the number of customers, but I think the common metric in SaaS companies, they were doing something like 400,000 of 40,000 of monthly revenue. It's just really just getting started. And I think, so that's how we discovered it as customers. Sonny emailed them. They said, we'd love to talk. We had a conversation. And it was one of those, Jeremy, where we kind of made a very quick decision. Didn't necessarily have to, but we knew the product. We knew it was pretty simple. We saw their very early metrics, but we made an early investment as a bet on a team and a great product. And in that case, I think we're just very fortunate. And that's one that's just been an awesome one to watch for a long time now. They're
amazing. Yeah. What did you see in the team? And you mentioned specifically the team, so not just the product. What did you see in either the product and the team at the time?
Yeah, so quickly on the product side, I had a little bit of experience with Salesforce at my prior company, and enough just to know that people had a lot of challenges using it, and
it can be complicated.
People would complain about it, and then maybe just convert to using a simple spreadsheet. And Pipedrive was just a very simple, lightweight way to manage, as you I'm sure know as a customer, to manage your pipeline and any, your investor pipeline, your sales pipeline, really kind of anything. And so that just, it was a product that worked and you could see using. On the team side, it was one, I think, the team were all, they're almost all, I think, involved in a sales training business. And they had a good amount of sales experience. And it was admittedly, more gut instinct. We had a couple of calls. We liked how they talked about their business. We liked their strategy, but we could kind of sense that they had just really good native selling skills. And that was good for how they could grow the business, but also kind of told us they knew their customer. They knew what it was to be a small business owner, maybe 1 to 5 employees managing a sales pipeline, or maybe just a small team within a larger company trying to kind of pursue leads efficiently. That was who they knew, and they've always kind of spoken to that audience really well through not only the product, obviously, but their communications and the integrations they've chosen to make. So it was kind of what we saw. I'll tell you one other thing. Even from the get-go, they were one of the teams that was just very consistent about putting out a simple but really helpful update. Like every month, almost to the day, you kind of hear, here are metrics, good, bad, how you can help. And literally, I funny enough, you mentioned it, I got one today. Giant company now, like they don't probably need to update me anymore. But they're just systematic about tracking their metrics, reporting. And I think that's one thing that's just super highly correlated to good overall performance.
Yeah. And I want to talk about at some point what advice, because I'm sure people ask you for advice, the companies you invest in. I'm curious of someone who took your advice and just actually implemented it and did an amazing job because of the advice. But I want to just point out, it's interesting. They experienced the pain points, right, at Pipedrive. And it's funny, I was on a call with another founder last week. I said to them, I don't have stock in Pipedrive, by the way. I just thought it would be good to organize. And so we did a screen share. I showed them how to create a pipeline in less than 2 minutes and add someone from the email and Gmail. And they were dumbfounded how easy it was. And I set up the columns for that, in my Pipedrive. I'm like, this is as easy as it is. And I'm like, listen, I don't have a horse in the race here. I don't make money if you buy them. And they're like, okay. They saw it, how easy it was. But, on that, they probably, Pipedrive sends you updates. They probably have that communication. They get advice. Can you remember a company that, or more than one company that basically wanted your advice, since you have a lot of advice helping a lot of companies?
Yeah. Great question. And I think you're doing this for a while now, and over, I think, about 140 companies since 2011. There really aren't any hard and fast rules. I will say that, one that I think about a lot is the more sort of independent the CEO founder is, the more they don't, in a way, need you, but they know how to strategically kind of connect with you, and maybe they know that you're particularly good at something, or you have a certain relationship. They tap into you, and in a short amount of time, you can provide a lot of value to them, but you're not talking to them every week and kind of struggling and why is this not happening? The more I would find to be concise about it, the more that you would spend with certain teams, the sort of better indicator that was that things weren't going the way they were. Whereas the Pipedrives of the world, they're off to the races. They might touch base with you, or you touch base with them, but it's quick and it's efficient. That said, where we've evolved to, there's kind of two main threads of, I think, what we provide. And one of those is just, connection and relationship with a founder, a person who's building something creative and doing something very, very difficult under a great deal of stress, having someone they trust, they respect, they know kind of has their back, cares about them and cares about the product, and shares that vision in the product, wants to see it come to fruition. That means a lot, and particularly the ones who bet on them early before it's kind of looking like they're going to be successful. So just having that relationship, and I'm lucky to have had that now over a number of years, and being able to kind of problem solve and have any kind of conversation. And the range is really wide, and even just that ability to talk through a topic that I might find sitting in my office really, really simple, they're like, wow, that was really helpful just to be able to kind of brainstorm and even have you ask me those questions and then kind of get to the answer with you kind of listening and telling me what you think. That's subtle, it's subjective, it's simple, but sometimes I think it's pretty helpful. It's definitely part of the job I enjoy, a part of the job I enjoy most. The other side is more tangible. If you look at our background, Jeremy, relative to some other venture capitalists, we are a lot more financial markets, transaction, quantitatively oriented. So whereas you might have certain investors that have domain expertise or that have functional skill like marketing or great with publicity and media, we have a lot of experience raising equity, raising debt, M&A, and frankly just like building models and kind of going through and helping them figure out where the soft spots might be, where mistakes might be, how to sort of present what an analysis looks like. And so companies will often turn to us and say, what do you think of this? Or here's my cohort analysis on my subscribers. Does this make sense? And we might, my partner and I kind of just, pull it apart, maybe do something offline, help them. And so it's much more tactical. Maybe it's an introduction to a bank. Maybe it's going through a term sheet or a legal document, those kinds of things. And what we'll see with a number of our companies is they're raising money from 5 to 10 other investors. And my hope is that they can have somebody who's an awesome professional CEO coach or an expert in marketing. With us, they're kind of getting a very light, but in terms of time commitment, but that sort of CFO banking skill set to be contributed, plus some of the other, again, intangible or relationship elements.
Yeah, that makes sense. And it's interesting because obviously they're engaged with you not just for the investment purpose, but for your expertise so they can grow. And so it's interesting, they may pull in different investments, but also the strategic advice for different purposes. And it sounds like yours is which is a huge need because I don't know. I mean, if we stereotype founders, visionaries, they're not like, let me build a model for what, right? They're not going in with a mindset, I would say stereotypically, right?
Yeah, that's for sure. And I think many of the people we work with are some mix of very creative and very, very deep on an industry, or they've spent years developing a product or discovering something. So this skill set that my partner and I built over a number of years, which I think is, in a way, it's rudimentary, but we spent time practicing it, honing it, and refining it. If we can kind of couple that with that skill set of a founding team, which yes, they're not necessarily wired that way, and sometimes the shorthand, especially in a business like food, the metrics like net revenue, gross margin, even really getting a good calculation of cash runway. Some of these things are, again, they might seem pretty simple, but all founders are not created equal. If I'm dealing with a person who's built and sold 3 companies and really knows the drill versus someone who's new, and the new person might be awesome, but they need some help. And that's not gross margin. Gross margin is actually going to be 1,000 basis points lower, and therefore you're going to need cash 6 months earlier. So if we can help them just kind of zero in and even be better at explaining the quantitative framing of the investment to other investors, that's a service we can provide.
Yeah, I think that's a really, you say rudimentary, it's just because it's what you do naturally probably, but most people would say it's not. And, we're talking about inventory planning. It's got to be difficult with a physical products company because the more you sell, then you need to buy more to supply. So it's got to be a tough tough model to work out, I imagine.
Yeah, absolutely. And that's one of the sort of traps, I think, in the CPG industry specifically, that the early stage investor can fall into, because the product might be great, but it often can take a lot of capital. And debt capital is often not, people working on this, but debt capital is often harder to get at at those early stages before the business is proven and or profitable. So some of these companies that look great, but they might need to raise tens of millions, 100+ million of equity to get there. We try to find companies that find a way to be cash efficient or show that they can grow profitably without a lot of investment, so that ultimately our business is really about investing in an early stage and getting a great multiple at exit. And the more, I'm saying again the obvious, the more that company needs to raise, the harder it is to get that return.
So what was the idea, Zach, behind Newground when you first started it?
I will say it was very organic. I spent about 15 years in the call it conventional investment management industry, doing a really wide range of transactions across industries, generally later stage companies, and had a great background and experience both on the sort of technical elements of transactions, as well as the good fortune to see a lot of companies, see a lot of CEOs, learn about a bunch of different industries. And I got to the point where I really wanted to do something entrepreneurial. And didn't know what that would be. Actually took a little bit of time in that sort of 2010, 2011 window to explore. So I thought about startups in a couple of different industries. And got to the point where I think I realized, one, my real expertise, or what expertise I had, was in the on the investment transaction side. And for better or for worse, wasn't ready to make that leap into the unknown. Yet, if I could kind of direct that skill set and that framework and history I had investing capital for that prior 15 years, if I could direct it towards companies with focus on early stage and growth companies, it comes with a focus on health, food, education, those that I was interested in, that would be kind of interesting. So I spent a couple years, as I alluded to, just doing personal angel investing, including with a couple friends here and there, like Sonny, for instance. And just realized, like, I love that. One, it allowed me to get closer to the founders and teams and have like a more direct impact on the companies. And two, everything I was doing was, it was I was always around super smart, creative people with a lot of good energy. And three, I'd say I was able to kind of focus it on those industries I was excited about. And by the way, where there's growth, where there's innovation. And so after doing it a little bit, I said, that's kind of where I'm headed. I kind of see myself heading there, and let's professionalize it. So raise outside capital. We don't have a big team at all, but start to build a small team and just be able to do this, better, a little bit bigger, stay early stage, stay in that kind of, 1 to 5 million of capital raise, 1 to 10 million of capital being raised kind of zone. So we could still be involved at the growth stage, the real growth stage. But make it into a business as much as we could.
So the first thing you do, you discover this, here's my expertise, here's some of the stuff I'm interested in, and you go to create a fund that you will go out. So when that original idea, were you thinking one particular niche, or were you thinking, oh no, we're going to do health, or we're doing technology? What were you thinking in the beginning?
It's a great question. I went back and forth on that a lot, and I have friends and people I like a lot who are deep on education, technology, food and beverage, and we work with those funds a lot. And there are certainly advantages of that, and I see it. On my end, I think it was a function of being a generalist previously, and then we have a view that we're there within our niche, within our early stage niche, we're there to deliver the best possible risk-adjusted returns to our investors. And there's something just intellectually I think I wrestled with, which was could I really do that if I narrowed my mandate to 10% of GDP, 5% of GDP, versus could I create a business where I was deep enough to make smart investment decisions in these industries, but able to see across a wide range of industries to kind of try to judge the best risk return. Hopefully and this is over a long period of time, hopefully build sort of cross-functional expertise, because any industry can get too narrow, and, to be able to share something that I learned in one industry and transfer it to another. So we did wrestle with that, but ultimately settled on kind of these three major and very broad buckets, deep tech, software, and consumer.
Zach, do you remember the first investment that kind of took off that you were excited about early on?
Yeah, great question. I think the first investment I made that did extremely well was SoFi.
SoFi.
So I invested in SoFi in, I think it was 2012. Another one like a Pipedrive, where it was the good fortune to meet them. I met them through a firm that passed on the investment. I was just doing a kind of general catch up with someone. It was a more kind of fun, it was an established fund at that time. It wasn't right for them. But I knew pretty much after the first call that it made sense to me, and it was super early. Made that bet based on the team, based on the vision, and just we got very fortunate they were able to grow as they have.
Was that Pipedrive or was that someone else?
Oh, that was the SoFi.
Oh, that was SoFi also. Okay,
SoFi.
got it.
Yeah.
So they passed just because it wasn't within the normal range that they invest in companies? Is that why?
It was a little early. I actually introduced it. It's funny. I introduced it to a couple other angels, friends who passed as well. At that stage, it is very hard to know. Other than if it's the guy or gal who's making, his or her fifth startup after all the successes, it's just hard to make that bet, and you certainly don't have certainty, but even with a kind of probabilistically, that's kind of also the reason for why we have 140 investments over 10 years. It's we believe in diversity, within each pool.
Yeah, it's interesting. They're like, "Hey, Zach, I don't like this company, but here you go." But it's just because you're in a different range of probably maybe their early stage and that company's later stage.
Oh yeah, and I think it's a field where really smart people can disagree. I had friends tell me that spindrift was a bad idea. Just kind of name your company, especially at this stage, because if you can't say, "Oh, look at this traction," well, these are pretty early. Reasonable people can disagree.
I always like to ask Zach, what's been a big miss, and because it's like you said, hindsight's 20/20 after the fact.
Yeah, it's a great question. I've got my list. There's plenty of them. But I had real shots at I'm thinking of two right now. I think there's a couple more, but definitely at Carta, which is worth like $7 billion or something. I could have done that at like 10 pre or something like that.
Wow.
And there, to your question, it was, I kind of liked it, but as a person who had an angel portfolio and managed it on my own spreadsheet and everything, I was like, well, what do we need all this for? So, and I think, look, like anything, it's a function of where you are at that moment. And do I feel like I'm full on exposure? Do I feel like I'm, I just had an exit, so I'm ready to, kind of wait. And that was just a moment where I, for various reasons, said, I just, nothing negative about the team at all or the company. Just didn't feel it. But big miss. And then Peloton. I had and that was not entirely my decision, but that was one where, meaning there was some negotiation with our partner that we were working on at the time. But that was one that we saw very, very early, and ultimately weren't able to transact. But obviously,
I'm always curious about that.
I bought the stock after the pandemic, though, so I've made it double or something since then.
I'm always curious about that because, right now things are obvious, but at the time it's not so obvious. So I'm wondering what you see or you don't see. I've had past people on that said they passed on Waze early on. They passed on, one person passed on Salesforce early on. What was it with Peloton? Obviously you saw a lot that was good. Was there anything at the time that was like, oh, I don't know if it was a category thing or what was it that didn't kind of line up?
Yeah, I think it kind of gets to how, for me, the thing I wondered the most was how big is the market for a $3,000 bike, and does this, it's one modality. Does it really persist? Is there value in this whole distributed ecosystem, being able to race your friends, and all kind of questions. I felt like the risk return was very good and was ready to go, but it was more about that, just like the size of the market, given the price.
Yeah, totally. I could see that. It's like, well, you have a stationary bike and you can get one for whatever, much less.
Yeah, put your iPhone up here, your iPad up there,
right?
You're good.
What do you look for? Maybe let's talk about your food company, because I love food. Zevia is amazing. Kevita is amazing. Copra is delicious. What's one of the drinks? How did you discover Zevia?
So I don't think I'd ever tried it. I'd seen it in Whole Foods a number of times. We got approached. It's funny. I don't remember how we met them. I think it was just through a mutual friend in the industry. And we're just super impressed with the CEO, Patty Spence, who actually led a management buyout after a lot of experience in the industry, bought the company, I think something like 10 years ago. We invested after that. We invested in like 13, 14, and have made several investments since. So it's one we've kind of followed, watched, invested in again as we've seen them hit their milestones. But no, it's funny. I mean, I don't think I love how you said, there's no artificial sweeteners. I don't think I even appreciated stevia as a plant. It's not an artificial sweetener. There was all that noise about, it has this aftertaste. And I'd say a couple things. One, even when we originally invested, I got to the point where I thought this product's really, really good. The product's gotten meaningfully better over the last several years. They've gone from, I think, 7 or 8 ingredients to 4. It's very clean and I think the taste has just gotten better and is more broadly appealing. And to have a 0-calorie beverage that people just love, and these fun, diverse flavors, and you can appeals to a wide cross section from youth to adult. It checked a lot of boxes, and you could kind of see the writing on the wall as has been evidenced with soda. And so soda is a just massive category, $75 billion or something, I think, in the U.S. And have a company that at the time, I think when we invested, it was 20 or so million of sales. And we felt like, maybe it will be a huge company, maybe it won't, but there's a ton of room to grow. And we just liked that we were investing behind a seasoned CEO, had invested a lot of his own capital into the business and just managing it really, really well. And it's one where I feel like we've just been lucky to have gotten involved in an early stage.
Zach, I love to hear, I love hearing your mindset behind why and some of the check boxes that have to be there or really doesn't move forward. Because I'm sure a lot of things come across your desk and you have to give a lot of no's for every yes. So you mentioned a couple. I'm just curious, maybe in your head, your check box, you have to check these boxes. You mentioned a big category. Is that like a definite, it has to have a big opportunity? What are some of the check boxes you're thinking of for you to even consider it?
Yeah, it's interesting you say that. We definitely study the market and want to understand the size and the potential scale. There's no way around that. We don't have sort of a starting point of has to be a huge market. I think a lot of folks will kind of come into this and think, where the unicorn is going to be, and this industry needs to have a unicorn, and who's the team to do it. Not to oversimplify, but our approach is a little more micro, which has pros and cons. So it's going to come down, I think, to a few things, a lot of which we have in common with other investors. First, it's your first exposure to the company is the team. What's your rapport with the founder? And it's a mix for me in particular of someone who is very knowledgeable about their business and feels like they're eat, sleep, and breathe this company and have passion for it, and also are commercial. That's a huge part of it for us. Someone who really is ideally not necessarily in having started a business or being in banking or anything, but kind of understands money, knows how to manage capital. You feel like they'll be responsible stewards of it. It means a lot to them. I had a founder once tell me early on, like, listen, this is when I made a personal investment. Like, I know you've invested with your own money. It's the only person who's ever said this to me. It said, I know you've written a check with your own money. I want to tell you, I appreciate that, and I'm not going to lose your money. Literally word for word, I'm not going to lose your money. And that meant it was after I decided to invest, but it kind of reflected the person that ended up turning out really well. But I love that mindset. Like, it mattered.
They treated it like it was theirs, right?
Exactly. So CEO, that early relationship, do you feel like you're being educated? Like they've thought of the issues. Another one, do they love questions? Do they kind of embrace question and challenge, or are they defensive and closed? And that's a huge thing, huge red flag if someone bristles or has to cut off. And I love the CEOs who are like, just whatever you got, bring it. And I enjoy maybe you'll teach me something, or maybe I'll just show you how much I know about my business. CEO, and then I'm skipping a lot of things, but I'm kind of trying to highlight what's most important. It's that sort of economic framing. And I say it generally because it's everything from the unit economics of the business to the cash burn and the cash needs that the business is anticipated to have, and the transaction. So we care a lot or more than the average venture investor that we see. Whether it's, we might really like the company, but it's 12 million pre-money and they have very little revenue. That's hard for us, especially in a business that's going to grow most likely in more of a linear kind of way. We want there to be a really strong upside if we're right, really strong upside case if we're right. We think a lot about downside too, which again is not so much the purview of venture investors. It's much more important to have the giant home runs than to not lose money. But we're sort of wired in a way that we want to lose money less often, and we care that let's say something we think it has intellectual property, an asset that if things don't work out so well, we could recover some meaningful portion of our capital or maybe make a profit. If things don't work out great, we love it when we feel like we can kind of come out whole if we don't hit the home run.
Yeah. Well, it's tough, and thanks for sharing that. Yeah, I mean, I think someone who's coachable. It sounds like embracing the questions, and really focuses and realizes the economics of things. I'm curious on the traction side of things, right? Because it's tough because you're going early on. What's a company that didn't have a lot of traction, and why you invested?
Yeah.
Can you think of one or like really early on that you kind of saw the vision of it, but maybe they didn't have a ton of traction to go off of?
Yeah, and look, sometimes it's about judging what traction is. And I think about a pharma company. We don't do a lot of pharma. I think we've done a handful out of the 140. And in this case, it's a company called Remedy. It's now owned by Biogen. And it's a drug to treat people who suffer from stroke. And this was one, it was super interesting, that one of those where the entrepreneur actually found this research by walking into a lab, I believe it was the University of Maryland a long time ago, and went from that stage to getting the company funded and running trials and ultimately exiting. So really cool entrepreneurial story, CEO we think really highly of. At the time, the only traction was there was a 10-patient trial. And in sort of science circles, that doesn't mean a heck of a lot. You certainly can't. Right. Most likely can't sell that to a pharma company or take it public with 10 patients. But the evidence was really dramatic. They essentially reversed. They took something that was like an 80% death rate, made it an 80% survival rate in the 10 patients. And then, of course, you backfill it and you try to understand the science. And this is one where there were a number of experts investing or had invested already. So we were able to to kind of diligence the science pretty deeply as non-scientists could. But it was one where they had trouble raising money, for sure. And we're turning, and that was before the fund started. They were turning to angels and high net worth individuals to fund them, and we're able to accomplish a lot with a little. But it was kind of that bet that that's a
tough one. Yeah. Zach, I was talking to a medical doctor yesterday, actually, and we were talking about the topic, and he's like, I don't think I'd ever invest in a pharma company because it's so hard. You need so much money. There's so many trials. It's just so difficult. So it's a big bet when you do that.
Yeah. And that was one, we've actually backed this team 3 times now. And their strategy is somewhat unique. They take existing compounds that have a proven safety profile and then try to repurpose them into some other use, and not just out of the blue. They're talking, the scientists, as you know, are all the time are looking at, just like they're doing with COVID, does this drug do this? And they're able to find these kind of interesting phenomena, often in research, and then hopefully acquire the compound for very low amount of money, get a bunch of protection for it. So you skip a lot of the development.
That makes sense. That's smart. It's like growth hacking and creating drugs.
Exactly. More capital efficient. I agree. It's a very hard industry, especially for people that aren't scientists.
What about Nimble? Nimble is another cool company that I've come across.
Yeah.
Well.
That's one I'm not super close. Met them through a founder who's a friend of the founders. It's a similar thesis to Pipedrive. It was maybe 2 years after I did Pipedrive. And it's one I'm not as close to. I think grown reasonably well, not to the scale of Pipedrive, but like the company and feel like they're it's a solid solid product that's that's certainly grown since we
Totally.
invested.
Talk about team for a second. You've assembled a team. How did you assemble a team? What were you looking for?
Yeah, great question. I started off on my own, and then I was fortunate to find a person who's our director of operations right now pretty early on. So the first fund was really the two of us kind of in a co-working space in Westport, Connecticut, getting off the ground. I knew that for fund two, that if I was to grow, that I would need to expand the team. So again, got pretty fortunate that maybe 6 months before that would have been the right time to start down that path. I met someone, Anthony, who has a pretty similar background to mine in terms of having an extensive financial background, a lot of private equity and credit experience, and was interested in some ways for 4 different reasons. Interested in the early stage. He comes at this more from a technology standpoint, like interest in technology, software, AI, the pharma and biotech. As you know, I came at it a little more from the food, beverage, healthy living angle. So between the two of us, we covered a lot of ground in terms of industries we know and can diligence. But that kind of common lens of looking at a company, evaluating the risk return of the investment, as I talked about earlier, helping the founders on the analytical side, and then just having that just more relationship driven. We're two like very intense guys in terms of wanting to do good work and wanting to be successful, but we're also collaborative and just want to have good relationships and support and not be about us, all that stuff. We really try to pride ourselves on building the long-standing good relationships with both the teams and the other stakeholders we work with.
How do you find companies, or how do they find you?
It's a myriad of ways. At this point, we get a lot of inbounds from just people finding our website or LinkedIn. So the long tail gets us to 1,200 to 1,500 deals a year that just come over the transom, of which we will do 5 to 10. So it's, as you said earlier, it's a super low.
You doing 1%? Like 1% is pretty much what you'll end up.
1 or below for sure. And so, the ones that I'll tell you, the ones that we end up spending the most time on. Well, I'll get back to that. The thing we try to be as democratic as possible. Like literally look at everything, even if it's a person we don't know and it's coming in off the website. You never know. Occasionally those surprise you and they get to you for a reason. On the where do we spend most of our time? It's through the sort of network of trusted relationships that CEOs we've backed in the past, our investors, other sort of friends in the industry who we've invested alongside. Because then you kind of speed up a lot of the work. Is the person trustworthy, honest, that you'll get a lot of the benefit of their knowledge. And just it's more predictive that if someone else that made an investment or believes in this person, it's more likely that you'll get there. So I bet 70% of the time we spend on diligence is from people or other companies that we know.
So it looks like, Zach, so let's say 1,000 to 2,000 companies come across your desk. Maybe you invest in 10. What's a good ratio that you feel like, okay, here's what we want to be a home run. Here's what's going to be a single or double. And here's, you're going to have the ones that strike out. What's a good ratio to look at?
Yeah, we've certainly modeled that. I think something like 50-50. 50% are very good to home run. I mean, you're only going to get probably, with some notable exceptions, that 1 or 2 out of that 10 that are going to be home runs. The others in that top 50% are going to be 2 to 5x, something like that, and the rest will be sort of returning capital and failing. And we expect a high failure rate in this business for obvious reasons. What's
an underdog you remember? It looked like it was slow going, and then they just took off.
Yeah, that's a great question. I think Spindrift was definitely an underdog. And got to the point where the How I Built This podcast just did a story on Spindrift and Bill Krillman. So you can kind of hear the history that they had. But that was a soda company, a craft soda and a glass bottle company. And they did have, some good early traction. We invested, but it had kind of a limit. It was an expensive product. It had sugar in it. And a number of people, when I invested, thought, as I mentioned, don't see the thesis there, Zach. It doesn't make sense to me. And that was one. It's clearly part the founder, and just believing that this is somebody who knew how to figure things out and just had an intense drive to do so. And what he did, which Bill did, which was the early breakthrough, was basically convert this to a seltzer-focused company, so a no added sugar company, and a can. A can is the delivery mechanism, so it reduces the cost meaningfully. That got them into Trader Joe's, which really let their growth explode. And so that what it is, just for completeness, it's a fresh juice and vegetable only seltzer. So it's the only product on the market, unlike a LaCroix or Bubbly or these others, that don't use any flavors or artificial additives. It's just fruit and seltzer. It's a delicious product. And just figuring out the fact they could figure out how to do that, create a product that could kind of maintain its freshness and its taste and be delivered at a low cost, and then figure everything out with marketing and distribution. It's pretty remarkable. But again, not something that a lot of people were willing to bet on early on.
Yeah. Zach, first of all, I want to thank you. I want to point everyone. I have two last questions I asked, but I want to point everyone to newground.vc. Check out what they're doing. Check out the amazing companies they've invested in. I always ask, since an Inspired Insider, what's been a challenging time, low moment, what's been a high time. So I figured maybe for the high time, you could talk about maybe one of the fun exited stories. You have a bunch on your website, from Kevita to Case Next to 915 Labs to a bunch. But as a founder, entrepreneur, what's been a challenging point? And then we could talk about a proud moment.
Yeah, you also start with the challenging.
Yeah, start with the challenge. Yeah.
Look, I think just getting it off the ground was hard. I went from being in a senior role at a large fund, to I'll put it in quotes, but to kind of being an expert at what I did, to being an amateur. So moving into a new business where I didn't know a lot. And so on the one hand, I loved that's why I stuck with it. I loved the learning, and I loved the interacting with these CEOs and management teams, and finding the companies I was able to find. That was a thrill. But at the same time, there's a lot you don't know. There's a lot you're learning for the first time. There's a lot I obviously I would do differently if I had to do it all over again. So while you're going through that early phase and you question, is not necessarily, it's not questioning the decision to do it. But it's more, am I doing it right? Is this going to work? And partly that's why I waited a little while to raise outside capital. I felt at least, I can do this, I can do it professionally. But that period's a little awkward, and it's different. And I'm thrilled that I did it. I think it's kind of part of a journey that, you're lucky to have, to make that kind of a pivot. But there are days when it's like, this feels kind of different and hard.
I guess you could relate to the founders you invest in, right?
Yeah, and I think that helped, helps that you kind of share. It's different. It's certainly, but because I have a multiplicity of bets, and they're kind of putting everything into one, which I admire deeply. But yeah, that journey and the awkwardness and the challenges and little things you have to deal with, that's helpful then from sitting up on a high perch and, having and not really being able to relate to what they're doing.
Yeah, totally. What about on the flip side, a proud moment and maybe a fun exit story? Because that's ultimately, there have been some, I guess we call home runs in the mix too, which is always fun.
Yeah. Such a good question. I feel like the exit it's kind of it's a financial milestone. Like everything's sort of done. The story's almost written, and it's obviously a good thing, and it's the right thing, but it's almost a little anticlimactic, because it's simply the path out. Like for instance, maybe I'll combine the two. I was able to sell my position in an ed tech company pretty recently, just sold it to another investor. It was an early personal investment I made. Just out of respect, I probably shouldn't mention the name, but it was a content company, and I invested in it super early. It was founded by a teacher, a former teacher, and it was one where I love the idea. It was all about kind of reading instruction for kids in schools, and the way they were doing it, I thought was just smart. And it played out better than anybody could have expected. It raised,
especially in COVID, right? I mean, it probably went through the roof because of
and it's funny because I did it right as COVID was going. I sold and we used the product extensively. I literally probably use it almost every day. I'll just tell you the company. Actually, it's New Zevia. And just to give them a plug and a gratitude and some gratitude, they just provide great current events content for kids, and if you've seen the product at level, it can take any article and level it 5 or 6 different ways, so kids of different ages reading abilities can read it. But to see that grow to that point where it's in all these thousands of schools, and my kids using it, and I had as all of these, honestly, tiny part in their success, but proud to have seen that, proud to have helped a little bit, proud to have believed in them, in an early stage. And back to the question on exit, it worked out pretty well. Happy about it, but it wasn't so much the part of it that was the excitement as much as this is a product that's gonna live on and help people and be enjoyed by people.
Yeah. For some reason, I picture Kevita sells and you celebrate, but it's really, it becomes more obvious at that point. So it's anticlimactic. Is that what you're saying?
Yeah, a little bit. And it's funny, maybe back to the what are you proud of? It's like when you go to Whole Foods and there's a whole end cap of Kevita. When 3 years before, 4 years before, what the hell is kombucha? What the hell is Coca? That was the point when, early in kombucha, there was no health aid, there was no,
people didn't know what it was.
It really didn't. Yeah, it was GTs and Kevita. Seeing that and having your kids or having your mom see it in the grocery store and say, wow, I just saw your product. Seeing SoFi do a Super Bowl ad, even though, again, that's kind of long past, those are all just kind of cool to see that growth from these very humble beginnings.
Zac, are there any companies that you said, that other company said, listen, Zac, we're not a good fit, but you may be a good fit. Are there any like that in your universe where you recommended to someone else and it did really well because you recommended it?
It's interesting. I'm pretty sure, I can't think of a company right now. I do a lot of introducing, and the what I think I hopefully developed a good sense of among this sort of small but meaningful peer set I have of other investors is knowing what they like. I introduced Spindrift to a good friend, and I invested too, but they invested even more and I think done well with it. I've made a number of introductions to later stage investors as well. So here's the thing. Usually it's me saying I'm putting money in and I want to show it to you because I think that's the ultimate kind of endorsement, of course. And
you put your money where your mouth is. They're looking to raise more capital,
right? But then there are times where I'm like, no, this is a really interesting. I've used product and education technology. I've used it. I've sampled it. It's just not quite a fit. Maybe they're raising money at a valuation that's too high for us, given our kind of risk return lens, or maybe it's just we're over concentrated in direct to consumer beverage right now. But you should look at it. I do a lot of that too, it's interesting. Nobody really jumps out, but I try it in every case, honestly, to make.
You spread the Spindrift, it would be an example where we like it, I think you like it, and you bring someone else in to it.
Yeah.
So, Zac, I want to point people to newground.vc. Is there anywhere else we should point people towards online, or is that the best place?
No, that's great. Our website does a decent job of telling you kind of what we do. If anybody's interested in showing us a company or reaching out for capital they're raising, we're always happy to consult and talk. So just you can ping us on the website, and love to share more.
Cool. Check it out. Thanks, everyone.
Thank you.
What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I'm feeling like 100 grand.